Okay, hi everyone. This is going to be the PowerPoint video for Chapter 11. So, as I have here, right, owners of a business rely on corporate governance when delegating decision-making authority to management. Corporate governance provides rules, policies, and procedures for management to run a business. Similarly, when management delegates power throughout the organization, they rely on management control systems to help direct and control actions. Okay, so with that kind of being the preface here, this chapter is going to focus on, among other things, how management can use these tools to align employee incentives with the overall interest of the business, right? So we're going to be looking at specific divisions or area of a business and comparing what may be in their best interests versus the corporation as a whole's best interest. Now, any type of organization you have, right, there's going to be a different setup or configuration of it. And in a decentralized organization, the idea here is the decision-making authority is spread throughout the organization rather than being confined to a few top executives. So it's decentralized. In other words, it's not just one person. It's not like the board or something like that. It's not centralized to these people. In other words, we spread things out. We talk to people. We listen. We make decisions. And what are kind of the advantages and the disadvantages of this, right? Why do we want to involve everyone versus why don't we want to involve everyone? Now, the advantages of decentralization as we have here, right? This is going to leave management free to focus on other areas. In other words, there's only so much time in the day, right? And if they're going to get management bogged down in kind of the minutia, if they're going to really micromanage, they might not be able to focus on those like bigger picture items in the business. Okay, so that's like one benefit of delegating power, having a decentralized organization. A second one here, right? Lower level management are most familiar with their departments. So the idea here is any job you've ever had, right? If you're, if you're a cash register person, right? You're most familiar with what it's like being on the sales floor, dealing with busy season or the holidays, right? You're in the thick of things, so you can identify problems. You know what's going on at that level. If you have somebody from high up, right, who's making all of these rules and, right, like we've all had somebody that says, well, that, a job or something, well, it's like corporate that says we have to do this, or the bosses, right? They're not really in the trenches. They don't know what's going on here. So, in having a decentralized organization, we're able to get the perspective of kind of everyone involved. Likewise, right, this empowers and motivates lower level employees, right? If your voice is meaningful, if like they're going to take you seriously, then that's a good thing, right? You don't want to feel like disenfranchised or, I'm just a low level person here. Management does everything. Another, item here, it creates efficiency and it removes red tape for decision making. So in other words, instead of sitting around and just speculating, we can have everybody at the table. We can make the decision, get it done. Now there are some disadvantages of decentralization, right? So it's like anything, everybody's looking at their own interests, right? They may not be looking at the corporation as a whole, right? So, for example, lower level management, they might not be able to see the entire needs of the company, right? So, running a business is very expensive, right? If you're working at the cash register or you're like the manager of the sales department, whatever the case is, would it be great that everybody in your department got, unlimited vacation time and great health insurance and, 2-hour lunch breaks? Sure, right? There's a lot of things that would be going on there, but that wouldn't make sense for the business as a whole to operate that way. We kind of need these upper level people to see the interconnectedness of the business to determine what's in the best interest of the business. We can take your feedback, right? It's helpful, but we can't fully rely on lower level employees to make all of the decisions because it's like anything. Everybody's going to try to do what's their best interest. We're looking instead at the corporation as a whole best interest. Now, this can also create a little bit of disorganization and friction between departments, right? It's like everything. If everybody thinks and they know what's best and they get a voice at the table, it may not necessarily be the smoothest transaction, right? It could create jealousy, envy, anger, hard feelings, right? Sometimes it's easier to just kind of have a decision made from the top and live with it versus fighting it every which way. And then next one here, can stifle the adoption of innovative ideas that would be applied company-wide, right? So in other words, because we're looking at maybe in just our division, it may not necessarily be in the best interest of the company as a whole. So for example, right, if you work at the bank, right, you probably don't like the fact that they now are like automating everything, right? That they want to do online banking. They want to have it be touchscreen. It's the same at like McDonald's, right? If you go into like a modern McDonald's, they really don't have the option anymore where you can order at the counter. Now, from the division, right, from the kind of employees or the division of like the retail banking, that may not make sense, right? You don't like this. It's not in our best interest. We're going to lose our jobs. But you get these kind of like bigwig people at McDonald's, the executives or the bigwigs at the bank, and they make some type of argument. I'm not saying I agree with this, but essentially they find that that's more efficient. A robot or a computer is more efficient. It's in the best interest of the company. And I guess part of that's true, right? It is more efficient. Maybe a more compelling argument to me would be something along the lines, and this doesn't make it right, but if we don't do it, our competitors are doing it. So to kind of keep up with our competitors, we need to do it, right? But you can see, right, how there's tension between divisions, right? And what we may like or want in a particular division may not necessarily be in the best interests of the corporation as a whole. Okay, with that kind of as like a framework, right, responsibility accounting, right, this here is, and what I have here is responsibility accounting systems. They link lower level management's decision-making authority with accountability for those decisions. And the idea here in responsibility accounting is the manager should only be responsible for those items over which they have control, right? It's like anything. You only can control what you can control. If you can't control what's out of your control, you don't worry about it. So when we judge you, right, we evaluate you, we're only going to look at those things over which you have control. That's fair, right? And the idea here is it personalizes accounting, and it basically holds individuals responsible for their revenues and costs and any disparities they may have between actual and budgeted amounts. It's kind of like saying, hey, we want to treat you as an adult. We're going to expect you to be responsible and take care of what you have to take care of. If you don't do it, right, you're not responsible, that'll reflect in your performance evaluation. Now, in this framework, right, the term responsibility center is going to refer to any part of the organization over which a manager has control and for which the manager is responsible for cost, profit, and investment. Right, so in this way, right, we have to kind of know what a cost, profit, and investment center is, right? What do these terms mean? So basically, the idea here is the managers of a cost center have control over costs, but not over revenue or the use of investment funds, right? So for example, accounting, finance, admin, legal. The idea here is managers are expected to control costs and should compare them against benchmarks, right? So if you work in the accounting department, right, let's just say there is a grocery store, and it's like Walmart or something. You go there to get your groceries. You work for corporate Walmart. You work in the accounting department. That's great. You're basically in a cost center, right? You're looking over and have control over costs, but you really don't have any control there over revenue or use of the investment funds, right? You're not on the sales floor selling the product. You're not telling them which products to buy. Really, right? The only thing you're looking at are costs. Now, the managers of a profit center, in distinction, right, they're going to have control over both costs and revenues, but not over the use of investment funds, right? So, for example, here, a theme park manager, right? The idea with these is if you are a manager of a theme park and you manage it, you have control over the costs, right? What are these, expenses we're incurring, so on and so forth. And then our revenues as well, right? We're managing the customers that are coming in, the sales. Now, these individuals in a profit center, the managers there, right, they should be evaluated by comparing actual profit to their budgeted profit, right? We're looking at what these people have control over and then evaluating them accordingly. Finally, right, the managers of an investment center, they have control over costs, revenue, and investments, right? So maybe the vice president of a department, right? They have control over all of those items and can influence them in one way or the other. Accordingly, when we evaluate them, right, we'll evaluate them as such, right? What they have control over is what they're responsible for. That's what we're going to look at whenever we evaluate you. Okay, so when we're evaluating a particular division or a manager, right, a division within the company, there's a few different performance measures that we can use, right? So the idea here, the first one is we can use return on investment, right, or ROI, as a financial measure to evaluate investment center performance, right? So we have an investment center, right? If we go back, right, that would be... right, this guy right here. If we're trying to evaluate how that investment center does, we could use ROI. Right, now the equation for this is it's going to be your net operating income over your average operating assets. And your net operating income is the starting point. This is separate and different from your net income. So don't kind of confuse them. Make sure that you pluck out the right number there if you're doing a problem. And really what it is it's EBIT, right? It's your earnings before interest and taxes. In other words, you're going to run down that income statement, kind of hit one of those stop signs, the net operating income, before you subtract out your interest and taxes, right? That's where you're going to stop. That'll be your net operating income. And then your operating assets, right? It's exactly what the term implies. It's going to be your assets that you use to operate the business on a day-to-day basis, right? So things like cash, accounts receivable, inventory, PP&E, property, plant, equipment, and basically all other assets used for operating purposes. The idea here is it's average operating assets as well. So it's going to be your beginning operating assets plus your ending divided by 2. And as I have here, right, most companies use net book value for depreciable operating assets. The idea with this is it can artificially inflate ROI each year by having a consistent change in the denominator. In other words, because we're consistently changing the carrying value of the fixed asset, every year we're depreciating it, and we're making the operating assets change every year by virtue of the depreciation, right? Lower the amount, change the ROI. The problem with that is we artificially inflate it. In other words, because it changes each year due to depreciation, the ROI is going to change. So just be aware of that, right? Because we use net book value. All right, so that's like one way you can calculate ROI. right? Another way you can calculate ROI is through use of margin and turnover, right? And the idea here with margin is, when you're looking at this is going to be your net operating income divided by your sales, where your turnover over here is going to equal your sales divided by your average operating assets. The idea with these is, right, if you go back here, net operating income over average assets, if you were to kind of smush these together, these two equations, right, the sales would offset each other. They'd effectively cancel each other out, such that your original ROI formula would be there, right? Your net operating income divided by your average operating assets. But again, this is just another way it's presented, another way you could solve for it. If you're given a set of facts, right, and you don't have the complete information for margin or turnover, you might be able to use the alternative variation, or you could build out the margin, you could build out the turnover, combine them, and reach your ROI. Just two different ways to reach the same end result. Now, as I have here, right, managers can increase ROI by taking a variety of actions that change sales, expenses, or operating assets. For example, a manager may make an investment, that is to say, increase operating assets to reduce operating expenses or increase sales. Right, so the idea here is, if you look at it over here, we have example 1, we'll have our ROI, margin times turnover. And what's going on here, right, and that's giving us the equation for it. If we smush them together, right, we'll have 10% times 2, it's going to be 20%. Right, so this is kind of our baseline, 20%. We're going to look at a situation where we can, in that case, increase our ROI, right? So if we start with this as a baseline, then say, hey, the same thing, except let's say a manager invests in a machine, an operating asset, right? They make an investment in an operating asset. And let's say by virtue of buying this machine, right, we think we're either going to reduce expenses or increase sales. That is to say, increase our basically, our ROI here. So when you plug the number in over here, right, the 13, the 104, it looks like that went up by 13, the 104, our sales went up, right? So it looks like, in short, our sales went up and our net operating income went up. When you do the math on it, we're now at 25%. Right, so this is just showing, right, here's a calculation of ROI. We start at 20%. By virtue of buying a machine, right, we can increase our ROI. Making an investment in it, we can go from 20% to 25%. Now, this is kind of a big diagram here for spreading everything out, right? If you think about it, right, we know our ROI is our margin times our turnover, and you could even smush that together, right, as well to get that one simple equation. But this is just showing, how do you calculate margin, right? Well, it's going to be your net operating income divided by your sales. But wait a minute, right? What's your net operating income? Well, that's going to be your sales minus your expenses. But wait a minute, right? What are your expenses, right? It's your cost of goods sold, your selling, and then your administrative, right? Now with turnover, right, it's going to be your sales divided by your average operating assets. And the idea there is that's going to be your beginning plus your ending divided by 2. But your operating assets are going to be a combination of your current assets, things like your cash, accounts receivable, and inventory, as well as your non-current assets, like your PP&E and other assets. In short here, right, the return on investment, we're kind of looking at a little bit of income statement over here and balance sheet over here. You get real big with it, and then you kind of get smaller and smaller and smaller to where you can get to just that one equation with it. All right, now when we look at different performance measures, right, there's kind of good and bad with each of them. right? So there are some criticisms out there of ROI, right? Now the first one says simply increasing ROI may not align with the company's overall goals, right? In other words, if we're a particular division, right, and we take action to increase our ROI, we buy a machine, it may not necessarily be in the best interest of a company as a whole. Maybe we could deploy our resources in such a way that's better for the company. We should do something else. It's more efficient for the company as a whole. The other thing here is focusing too much on the short-term ROI, right? It may cause problems in the long term, right? So you're trying to increase your ROI. Maybe you got your R&D division, your research and development division. That's great in the short term, right? We don't have as many expenses for our R&D, but in the long term, right, we may not have new products, right? If we don't have a research and development team, we're not like spitting out new products, right? So Apple, if they cut all of their like software developers and programmers, that's great. They won't have those expenses that'll boost the ROI for the given year, but then they won't have the iPhone 25 or whatever, the new one. They need these people to develop new products. Likewise, right, many costs within a department are committed costs and are beyond control, right? So the idea here is if it's responsibility accounting and you look at what people have control over and don't have control over, some of the costs they really don't have control over. They're committed, right? There's no kind of going back with them. In this way, right, it can be hard to fairly gauge ROI if you include these committed costs as part of the calculation. You can't really change them either way. Is the person responsible for them or not, right? We're stuck with these costs. Finally here, right, another criticism of ROI is that managers may reject investments that lower ROI but would be in the best interest of the company. And that kind of goes to the first point there. So again, what's going on here? We're looking at a division. We're looking at the performance of the division. One way we're evaluating it is through this return on investment, right? How are they using their resources? And we're going to express ROI as a percentage. There's good and bad with it. And one of the good things is it's like easy to compare, right? It's a flat percentage. We can compare different divisions. But there are also some bad things with it as well. It's not necessarily the perfect solution. So another approach we could take, right, to help us measure the investment center performance is residual income, right? That's another way we can look at it. And this formula here, residual income, this is measured in dollars, not a percentage. And really what's going on here is residual income, as I have, is the net operating income an investment center earns above the minimum required rate of return on its operating assets. It's kind of that's residual, what's left over income. And the goal here, right, is you want to increase your residual income within a department. So the equation for residual income, right, this is going to be your net operating income minus your average operating assets times the minimum required rate of return. So if we look at these, right, here's a good example showing residual income versus ROI. They're giving us some information here about a corporation and a particular division. We're trying to evaluate that division. They're telling us they have average operating assets of $100,000, net operating income of $20,000, and a minimum required rate of return of 15%. Okay, so we have two different ways we're looking at this division. The first one we might do is ROI, right? So this would be $100,000, our average operating assets, divided by our net operating income of 20. We're looking at 20%. In distinction, right, if we were looking at residual income, in this case, right, it would be our net operating income 20,000 minus, right, our minimum required rate of return. In other words, the 100,000 in average operating assets times 15%, right? Our residual or leftover income, our minimum we have is 15. We made 20. That means we're going to have 5 in residual income. Now, the idea with residual income is that it's going to encourage managers to make investments that are profitable for the entire company, but will be rejected by individual managers evaluated through ROI. Right? So generally ROI managers, they're going to reject a project whose rate of return is below the current ROI, even if the ROR in the project is above the company's minimum rate of return. So in short, right, it's another way to evaluate a project to see, okay, maybe it doesn't meet our definition in our division, our minimum rate of return, but from a company-wide rate of return, it does. And we can prove and show that it's going to make money through this residual income, another evaluation. Right? So for example, let's suppose a manager wanted to buy a machine costing $25,000, and that by virtue of this investment, of us buying this machine, it's going to generate an additional $4,500 each year in marginal operating income. Okay, so we spend some money on a machine. This machine's going to help us make more money. All right, if we look at ROI on it, right? In the present, right, our ROI is 100,000 and we have 20, right? We're sitting at 20%. We then dump 25 grand into this machine, which is going to increase our net operating income by 4,500, right? It's like 18% there. When you add them across, right, the 100 plus 25, 125, 20 plus 45, 20, 45, we're looking at 19.6%. Right? Now, the idea with this is if we evaluated this project, if you imagine you were the manager in the division, you say, okay, that's great, right? It increases, we spend 25 grand, it increases our revenue by 4,500. But hey, I'm not really interested in that because our ROI right now is 20%. And if we buy this, even though it increases our, profits, it doesn't increase our ROI. So for that reason, I'm going to reject it, right? So from an ROI standpoint. So what we say to that manager is, hey, why don't you evaluate this from a second perspective, from a residual income perspective, right? So the idea here is you have your net operating income minus 15, you're standing at 5 right now. This is going to increase you by 4,500 and 3,750, right? It's going to make your residual income increase. You're going to go from 5,000 to 5,750. In other words, while your ROI decreases from 20 to 19, you don't like that. Your residual income increases from 5,000 to 5,750. In other words, it gives you another basis to evaluate the decision, to evaluate your division there. Next item here, transfer prices. Right, so a transfer price is the price charged when one responsibility center within a company provides goods or services to another responsibility center in the same company. And creating a transfer price is going to allow the transferor department to recognize revenue on the transfer, while also the receiving department to recognize an expense. So you basically have two divisions in a company, right? Basically a seller and a buyer. Maybe you have a company that does multiple things and they sell products from one to the other internally. Like one part of your company makes widgets, another part of your company makes TVs or something, right? Now maybe they need those widgets in the TVs. So the seller, right, the widget division might sell those widgets to the television division. And in that way, right? The widget division would have a revenue of selling their goods, and the television division would have an expense, right, of buying the widgets. Now, the question kind of becomes here with transfer prices, that's great, we can do this, but what price should we sell it for, right? Because it's like any deal, right? If you ever watch like Pawn Stars or anything, right? How do they come to a price? Well, the person selling the goods on Pawn Stars, they want to sell it, the person who walks into the pawn shop and is trying to sell it, right? They want to sell it for the most money they can get. On the opposite end of the spectrum, right, the people at the pawn shop, they want to pay the least amount of money, right? So we have this tension there of what we should sell it for. Now, when we're looking at transfer pricing, we said, right, that there may be this tension and there could be potentially opposite goals for what's going on, right? Now, the idea here that we want to try to avoid is this thing called sub-optimization, right? In sub-optimization, this occurs when responsibility center managers forego company-wide profits by making decisions that, well, perhaps in the best interest of their department are not in the best interest of the company, right? So in other words, this would be like rejecting a decision, saying we're not going to do that. It doesn't make sense for us as a department. But when you look at it from a macro level, right, it would make sense for you to do it and make that decision at the company as a whole, right? When those situations happen, when a particular division, their self-interests are not necessarily in the best interest of the company as a whole, and they act on that, that's called sub-optimization, right? We want to try to avoid that because, again, we're looking at the company as a whole. We've got to make sure that this continues to run, right? So if our goal is to avoid sub-optimization, we can use a few different approaches towards this end, right? We can have negotiated transfer prices, we can transfer at cost, or we could transfer at the market price. So let's kind of look at these here. Right, so negotiated transfer price, the basic idea here is we kind of just let the two divisions go at it, right? You figure out, see if you can come together on a mutually agreed upon transfer price. And the idea with this is you allow manager level negotiation on prices. It's going to follow a decentralization approach. And they basically, espouses the theory that, hey, management's in the best position to figure this out. They know what it costs them. They know what they're willing to pay for it, what they can sell it for. And in this framework, right, when you let them kind of resolve it, there usually is this thing called the range of acceptable prices. It's kind of like this window or a certain number amount that you can set the price at where it's going to make sense for both parties to agree to that price. So to negotiate this, right, let's look at an example, right, of negotiated transfer pricing. So we say we have Food Conglomerate Inc., right, that's kind of like the big guy. It's the corporation as a whole. Now say they have two divisions, right? They have a restaurant division and a beer division. Now a manager in the restaurant division approaches the beer division and he basically says, hey, we need to buy some beer to serve in our restaurants. And that's, so essentially we're looking at a transfer price here, right? We have two divisions, one company, one division is going to be selling to another. We need to look and see if this is a price we can work with. And then there's some basically universal information here, right? So we have basically the beer division information here, the pizza division here. Looks like ginger beer production capacity per month, 10,000 barrels. Variable cost per barrel, $8. Fixed cost per month, $70,000. Selling price of the ginger beer on the outside market is $20, right? What we can sell it for. And then with the restaurant division, they can purchase beer for $18 a barrel, and their monthly consumption is $2,000. right? So I just read that off. You can look at it. That's going to be the universal facts. Okay, so given those facts, right, the selling company, that is to say the beer division, they're the ones selling the items. They're basically, it's only going to make sense for them to sell this, right, if it increases their divisional profit. In other words, they're not going to sell this thing at a loss. So the framework for this, right, the equation, that is to say the transfer price must be greater than or greater to or equal than the variable cost per unit plus the opportunity cost. That is to say the total contribution margin on lost sales over the number of units transferred. Right, now from the buying division, the restaurant division, they're basically only going to agree to a price if it increases their divisional profit as well, right? They're only going to agree to a price if it makes sense for them, both parties. In this way, right, the buyer has to compare whether it'll have greater profit from basically buying it internally, right, accepting that price, or buying the same or similar product from an outside supplier, right? So that is to say the buyer's transfer price has to be less than or equal to the cost of buying from an outside supplier. In other words, they're not going to pay $50 for something internally if they can go buy essentially the same thing on the open market for like $30. That doesn't make sense, right? Now, if there is no outside supplier, then basically in that way, the buyer would use the transfer price would be less than or equal to the profit on each unit sold. Right, so given that kind of is like the general framework, it has to make sense for both parties in light of that equation. Right, let's consider the range of acceptable prices given three different scenarios. Right, so scenario one, the selling division has idle capacity. Right, the beer company, they can make this without a problem. There's going to be no opportunity cost. Scenario two, the selling division has no idle capacity. In other words, they're fully booked. How do we handle this? In scenario three is the selling division has some idle capacity, right? So maybe they can do some of the order, but they can't fulfill all of the order. So let's look at scenario one here, right? The selling division has idle capacity. Let's assume the seller, right, the beer company, in this case, the beer division, they have enough idle capacity to fulfill the order without sacrificing any sales to its regular customers. Specifically, let's say that the beer division, they can have a 10,000 unit capacity. They currently produce 7,000 units, right? So we're at 7, we're capable of making 10. Hey, we can take on this 2,000 unit order, right? So thus, in this case, right, our variable cost per unit, $8 is going to become the lowest acceptable selling price. In other words, when we plug it into, right, the information over here, $0 lost contribution margin, $8 is going to become our selling price. Right, now likewise, right, the buyer, right, they can buy similar beer from an outside supplier for $18 a unit. Right, so for them, the buyer, they're not going to pay more than $18. So in this way, right, when we have idle capacity, we can handle the whole order, right? We don't want to sell it at a loss, so we better at least sell it for $8, and the buyer's not going to pay more than what they would pay on the open market, right? So in between these two kind of points, right, 8 and 18, so maybe we sell it for $9, $10, anywhere in between those two spots, that's the range of acceptable prices where it makes sense. Let's look at scenario 2 here, right? So let's assume that the seller, the beer division, with the 10,000 unit capacity, they're already at full capacity, right? In other words, they're already selling 10,000 units to the outside market for $20 per unit. Essentially, in this case, right, there would be an opportunity cost, right? In order to fulfill this internal order, we would have to divert 2,000 units from our current external sales, right? And again, let's assume the buyer in this case can buy similar beer for 18 bucks a unit. So in this case, right, we're going to take the contribution margin, right, the $20 selling price minus the $8 variable cost times the $2,000, or I'm sorry, times the 2,000 sales that we have to divert, divided by the 2,000 units. In short, right, if we take the $8 variable cost plus that amount, we're going to have to at least sell it for what we're currently selling it for. In other words, 20 bucks for this to make sense. Right, we're not going to, in short, right, if you just think about it, if we're at full capacity and we're selling it for $20 on the open market, if we're going to divert any of those sales to an internal sale, we better at least be getting $20, right? We're not going to lower it, we're going to lose money here. So because our benchmark, right, as a seller is 20 bucks, but the buyer, they're not going to pay more than $18. In this way, there's not going to be any really room. It's not going to make sense for us to have, a transfer price here. There's going to be no range of acceptable prices. Then third here, let's look at scenario 3. The selling division has some idle capacity. So maybe we can fulfill some of the order. Right, so again, let's assume the seller has a 10,000 unit capacity. We're at 9,000 units, right, that we're producing and we're selling for 20 bucks a unit. So in this way, right, what would happen is we can fill 1,000, right? That's great. We can squeeze that in. We can fit it in there. But to do the whole order, we'd have to divert another 1,000 in sales from our current buyers, right? So in order to take this on, we're going to have to divert 1,000 in sales. We're at 9. We'd have to back out 1,000 from our current sellers, and then that gets us to 8, and then do your 2,000 order, okay? So in this case, right, it would be the selling price minus the variable cost. That gives us the contribution margin times those 1,000 in sales that we'd have to divert. Right, we would divide that times the 2,000 units transferred. So the 8 bucks plus that amount, we're looking at $14. And from the buyer's perspective, right, they're not going to pay more than 18. We would have a range of acceptable prices here, right? If we sold this for somewhere between 14 and 18, it would make sense for us to take on. And part of this, it basically comes from a combination of, we're losing out on some of those external sales, but we're making up for it because we're taking on and filling some of that idle capacity. So it's kind of like we lose out a little bit, but we can win a little bit, right? It would make sense here. We could do it. We'll be in an overall position if we accept a transfer price somewhere in between those two numbers. All right, another approach you could take, right, for transfer pricing is basically just look to the market, right? And this is called the market price. It's really, we want to sell this internally to each other. What does it go for on the open market, right? So if we had a widget that we sold on the open market for 20 bucks, we're looking to sell it to our TV division, we would charge 20 bucks, right? We look to the open market. Now, as shown in the prior example, right, if the selling division's at full capacity, then it really has no choice but to sell it at least to the market price because of opportunity costs. In other words, right, I believe in that example we were selling it for 20 bucks. We're at full capacity. If we divert any of those sales internally, then we're kind of de facto forced to sell it at least for 20 bucks, right? We're not going to take a hit on it and sell it for less internally to you. So full capacity kind of implicitly means market price anyhow. Now, as also shown, right, in the previous example, market price is less effective in situations where the selling division has some capacity and the market price, for example, 20 bucks, is greater than a price the buyer can achieve from an outside supplier. So basically, in some situations, right, where we had that idle capacity, we could use an alternative amount, right? It doesn't necessarily have to be market price. A second area here, and I think I might have accidentally skipped over it, right? We could use cost, right? So if we're basically looking to sell it from one division to another, just sell it at cost. Now, that could be measured as just variable cost, or it could be like full cost, right? Variable plus fixed costs. Now, there's kind of some issues here, though, right? First, this can lead to sub-optimization, right? Remember we said sub-optimization occurs when basically one company acts in their best interest, but it's not necessarily in the best interest of the corporation as a whole. Right? In other words, it may make sense for the company to utilize the seller's idle capacity, but it would cost less for the buyer to buy it from an outside vendor. Right? So thus, the buyer would not want to purchase it despite it being in the best interest of the company. So in other words, the buyer is going to say, we're not going to pay more than what we could pay on the open market, right? But if we did do that, right, if the cost in that case, it would be in the best interest of the company. So the buyer is saying, no, we don't want to do it. However, this is in the best interest of the company. If the buyer doesn't do it, right, that gives rise to sub-optimization. And then second here, right, if it's sold at cost, the problem here is the selling division is never really going to recognize a profit on the sale. Right? If you sell it for what you make on it, you're not going to have any net income there. You're basically just selling it for what it costs. Cancels each other's out. And then third here, right, if you're selling at cost, there's not really any incentive to control costs. Right? You can blow the cost up and have it cost as much as you want. You'll still sell it for that amount. Right? You don't have that kind of cost control constraint as heavily weighing on you. Now, a lot of times what happens, right, in like the real world, they might have 2 or 3 different sets of books and records they maintain for evaluating a company, right? So maybe they'll actually do it at cost, for example, right, because that would make the most sense for the business as a whole. But whenever they go in and evaluate the company, right, they would use a different measurement technique, like a different set of books or records for evaluation purposes. Maybe they would use market price, they would use a negotiated price to evaluate it. So again, it's in the best interest of the company as a whole, but because you're maintaining kind of dual sets of books and records about using one standard in actuality, but for purposes of reviewing the division, a second standard, like just for that limited purpose, you kind of get the best of both worlds. Finally here, right, service department charges. So we've been talking about this from a kind of product point of view. It can also be done with services, right? If you have different divisions that are like the nature of their business is providing a service, not necessarily a product, you can have one division provide services to another. And as I have here, right, operating departments carry out the central purpose of the organization, whereas service departments, things like HR, accounting, they provide services to the operating departments. Now, for a variety of reasons, service department costs are charged to the operating departments. We've got to basically make sure 2 things here. Service departments should charge variable costs and fixed costs separately to the operating department. And then service departments should charge budgeted, not actual costs to the operating department. So these are just some general rules, right, when you're talking about like service departments, things like accounting, HR. When they provide services to the operating departments, how do we account for that? Right, that's going to be some general rules there. So again, just going back here, This chapter, we really learned about responsibility accounting, right? We looked, at the benefits and drawbacks of a decentralized organization. We looked at evaluating managers for what they have control over. We looked at, if you're in a cost center, a profit center, and an investment center. And in that way, right, we provided different techniques, right, ROI and residual income, to determine how a center is doing, evaluating its performance. After that, we talked a little bit about transfer pricings, if we have different centers that are selling products or providing services to each other, about how we could set those prices. And at the back end, right, we talked about the service side of it. So with that, we're going to end the lecture here. We can hop in to some of the problems.